Good afternoon, folks, and welcome to the New York Alternative Investment Roundtable monthly call for January 2023. I'm Robert Akeson of the Riverside Management Group, the moderator. And today we are very pleased to welcome Dr. Lev Borodovsky. Dr. Borodovsky is the author of The Daily Shot, a graphical newsletter for financial industry professionals in an unbiased visual overview of global macro events. He is also a founding team member and chief risk officer of Star Mountain Capital, an asset management firm focused exclusively on the large and fragmented U.S. lower middle market. Dr. Borodovsky was the chief risk officer and managing director of the GSO Blackstone Credit Platform. Before then, Dr. Borodovsky was head of risk management for Alternative Capital Division at Credit Suisse. Prior to Credit Suisse, he worked at both Barclays Bank and JP Morgan in their risk management and commodities groups. Dr. Borodovsky is founder of the Global Association of Risk Professionals and is also the co-author of the FRM certification program and the Professional Handbook of Financial Risk Management. Dr. Borodovsky holds a BS in physics and mathematics from the University of Oklahoma and a PhD in physics from Columbia University. So the roundtable is very pleased to have Lev join us and share his perspectives on data and its significance, especially in terms of its ability to inform our future behaviors. The title of his discussion today is Data, the Big Picture. Now, before we dive into this very interesting and relevant topic, I do want to thank our sponsors, and they're up on the screen right now for you to see, without whose support none of this is possible. They include Alston Bird, Baker Tilly, Deloitte, Bloomberg, New Mountain Capital, Grant Thornton, Ultimus, and our not-for-profit sponsors, Kaya, and the Fordham Gabelli School of Business. And just a reminder to everyone, Lev is going to be answering questions from me for about 45 to 50 minutes. As you can see in the lower right-hand corner of the Zoom, you have the ability to send questions into Dr. Borodovsky and myself. Dr. Borodovsky will be showing some charts in a moment, but I just encourage everyone to sit back and enjoy. So Lev, let's get to it, my friend. Good to have you join us.
Thanks, Bob. Glad to be here.
Good, good. So Lev, is this a fair statement to make? The overarching question here is, what are the data trends telling us about the following, okay? What were the drivers of the COVID era inflation spike? And again, I just want to ask the question this way. It's important to look at the past because you believe the past, especially as it's manifested in data, gives us a good indication of what our future behaviors might take into consideration.
Sure, Bob. It's interesting. Just yesterday, the Central Bank of Canada said, we've got to do a full forensic review of this inflation spike we had. Nobody expected it. Everybody thought, okay, these are supply chain issues that sort of came, and it's going to go away as quickly as it came. And it's COVID driven. And so all of a sudden there was something far, far bigger than anybody expected. And so it's critical that, central banks go back and take a look at it, and governments as well. But what I find interesting is that there's so much noise out there about this inflation spike. And people just don't seem to want to look at what the data is telling. And the data says that the Fed didn't cause this inflation spike. There's no evidence of it. right? Let's take a look at some charts, and it's just I think it's going to make it more
And
clear.
Lev, before we take a look at the charts, let me ask you one question here. So your efforts are really not to distill and provide narrative on the data. It's to present the data, correct?
Correct. I try
or to identify data that's significant.
Yeah, I try to show trends that are out there. I obviously show what people's views are in terms of forecasts and projections and consensus projections. But the goal, I try not to inject my opinions into the dialogue here. We're lucky at the Daily Shot. We have some of the brightest minds in the financial world, and they don't need to be spoon-fed. What they like to see is information, right? They will decide,
Yes.
and they will digest the information as it comes their way. And so my goal is not here to make projections and insert my opinion and so on. But I will certainly point out what the data is showing, what the data isn't showing. And that's kind of why I wanted to take a look at some of these, just a few charts. So let's start with this. Let me just see if this works. Can you see that?
Here you go.
Okay. So the big question is, what's, we know that the Fed did a massive amount of quantitative easing. They bought enormous amount of securities. And
so Lev, before you proceed, I'm not sure how this appears on everyone's screen. Okay. But what you might want to do is just define the line versus the bars.
Yes.
I'm not sure everyone can see that.
Yeah. So this particular chart basically says, here's the blue bars are,
Yes.
The quantitative easing, the securities purchases by the Federal Reserve.
Okay.
And the line is the S&P 500 price to earnings ratio, right?
Got it.
And so what this is telling you, that quantitative easing, or the Fed's actions, are more likely to cause the financial markets to respond than they are the actions than any kind of response from individuals, households, right?
Right.
So this chart shows, yeah, financial markets will respond. There will be an impact on financial markets, but what really where the data is showing me is that the real spike in inflation was caused by fiscal stimulus, and it's not just fiscal stimulus as a whole. It's specific kind of fiscal stimulus, the kind that injects cash into the households. So imagine a situation where you have tight inventories, right? You have COVID, you have tight inventories. Production's been down because people are not at work. Companies have slowed production because they thought demand is gonna kind of vaporize, and so you got tight supplies, and all of a sudden you have households loaded with cash sitting at home and taking action. Now people say, well, what about the Fed? Didn't the Fed, inject capital into the financial markets? It did, but Bob, do you know anybody who's got cash from the Fed, right, to spend? No, nobody did, right? It's that's a different kind of capital injection. Yes. It helps the banking system, and it does inject liquidity into the financial system, but it doesn't immediately directly impact households. What does is this. This is just it's not a comprehensive list, but a list of what happened, in post-COVID capital injection into U.S. households. We had 3 government checks, right? And people say, well, what's the big deal? I mean, just a few checks. For a lot of people, this was more money than more cash than they ever had in the bank, right? And just
so really what you're saying, Lev, is that certain actions by the government have greater multiplier effects.
correct. Specifically when it comes to inflation, right? When it comes to business activity, it's debatable, but certainly the data shows that when it comes to inflation, these are the things that had the biggest multiplier. Direct, cash to households, the unemployment benefits. I mean, I had several friends who filed for unemployment. There were some were making more money on unemployment than they were in their job that they lost.
Okay.
So you're talking about, in addition to the regular unemployment, $600 a week of juiced up unemployment for quite a while, and then it went down to $400 a week, but it's still significant. You had child tax credits and other tax refunds. You had some employers were required to pay sick leave and medical leave. You had student loan deferment, right? And we still
Yes.
have that in effect. And again, people think of it as a separate thing. No, it's part of the inflation story. When you're sitting at home, you used to have $400 a month or $600 a month you had to pay on student loans. Now you don't. All of a sudden, that's cash in your pocket
Yes.
that's coming in. You had mortgage forbearance. A lot of mortgages stopped paying. You basically, again, all of a sudden, when you had those bills before, you don't have them anymore, and you're sitting on cash. You got rent eviction moratoriums and sort of emergency rental assistance. So in the past, if you stopped paying rent, you'd be evicted for a good year. I think you basically, in most states, you couldn't be evicted.
Yes, that's right.
Again, that's typically you write a check to
Certainly a state like New York. Yes.
right. And all of a sudden that money's going into people's pockets. And then there's this massive small business forgivable loan program. Now people say, well, that goes to businesses, not people, not individuals, but small businesses who is employed by small businesses. A lot of times it's your family members. And so all of a sudden you can pay your family members, keep them on the payroll. And so cash kept flowing into households. People had savings that haven't had before. All of a sudden they're staying at home. They've got their screen up. They're bored with their job meeting, and all of a sudden they're like, okay, let me go shopping. And by the way, some people went shopping for things. Other people went shopping for stocks, cryptos, and other things like that. And so both things kind of, inflation spiked in both. And that's why you had some of the craziest run up in
the meme stocks, right?
Yeah, meme. Yeah, so speculative assets.
Yes.
You had some of the biggest moves in those, and this sort of thing is part of the dynamic here. And people are now looking back and saying, wait a minute, some of these events contributed to this inflationary spike. And again, if you contribute, let's say the federal government contribute to states, that has an indirect impact on spending, but it takes a longer period of time for that to propagate through the economy and show up in CPI reports, right? If you provide cash to a state, it takes a while for that to show up in somebody's pocket. They have to get some sort of a job paid by the state. they have to get their check from the state, and then they spend
Yes.
it, right? So that process is much longer. And so not all fiscal spending is the same. And in particular, it was, the fiscal spending focused on households, direct help to households. And I'm not saying there's anything wrong with it, necessarily. It's just the fact that immediately had, if you're sitting at home and you have things that are in your house that are broken, you've never been able to fix them, all of a sudden you have cash, I'm going to go, buy some things to get my house fixed up, or
Yes.
things like that, right? And so you can see this inflation surge, coinciding with some of these injections.
Yes. And before you turn, just go back 1 second. I just
Yeah.
want to ask you a quick question. So just out of curiosity, and I know most of our viewers are very familiar with the CPI. Why would you choose the CPI over the PPI here? And I'm not really, the question has broader significance than that. In other words, what determines for you the questions you should be asking, and where do you go to get the data? How do you know that these are important questions?
Yeah.
What's your framework?
So the Federal Reserve is clearly focused on consumer inflation, and they're focused on PCE inflation in particular, and
Okay.
core PCE inflation. And that's kind of what everybody is looking at. But the core PCE inflation comes out later in the month. The first thing that comes out is the CPI. It's another consumer inflation index. And usually around that same time, the PPI comes out a little later. The PPI gives you an indication of some components of the PCE inflation. So it allows you to kind of predict what once the PCE comes out, what it will give you. But it also gives you an idea of what's upstream, what's happening upstream, right? Are there shortages, or there price spikes upstream before they get to the consumer? And so that's the kind of the focus on the PPI. But obviously the CPI, if you look at the most influential economic report over the past year, has been the CPI report. I mean,
okay. And so are you relying on, let's say, any publications in particular for your data, your framework, for helping to shape your view of what's important?
I mean, to me, I just look in terms of the immediate publication. It's the government's report on the CPI. That's the key report. But then, obviously, I'll look at different financial publications that come out. Anything from Bloomberg and the Reuters, the Wall Street Journal. Depending on what we're looking at, different publications apply, right? In terms of the CPI, the Wall Street Journal does a really nice job. Bloomberg does a really nice job in terms of detailed coverage.
Yes.
But you look at some of the other indicators. European inflation, you may have the Financial Times and Reuters cover that better, or things that are going on in Asia.
So the point here, Lev, is that you yourself rely on a broad array of sources to help you frame out the important questions to be asking here.
Yes. And part of what I do is I try to, because as you can see, I spend a lot of time on charts. I don't like to put a lot of text in this.
Yeah.
People don't need it. They have plenty of text coming their way. But I often will put a link to an article that will give you more detail.
Yes.
On what's happening, and particularly if there was a surprise. And surprises are key to me, right? It's not the absolute level of the data a lot of times. It is what was expected versus what did we get.
Yes.
Right. And so that divergence is what drives markets. It's what you hear the ECB talking about, inflation surprises, right? They're not always talking about just inflation. They're talking about inflation surprises, meaning they have their forecasts. If things follow their forecast, they're content in following their policy. It's the surprises that are key, and we've had a few inflation surprises last year, and that drove the markets, and it really shook up how the Fed approached the monetary policy,
Yes.
and became aggressive. So that's, does that kind of help with that? Anyway, so this is the chart that kind of combines the events of fiscal stimulus with the inflation trend. This chart from the Tax Foundation did a kind of back of the envelope calculation that basically said, your typical, middle class family, lower middle class family, potentially could have gotten $70,000 a year in government support
Wow.
last year. I mean, it's again, some of a lot of this is the replacement of their wages. So they lost wages and instead got unemployment benefits. But my point is here that this has not happened before, right? And going back to why it's not the Fed, but this that caused the inflation spike. The Fed did quantitative easing twice before, and the U.S. economy continued to be in a what I call disinflationary environment, right? This kind of thing has not happened. I mean, you basically take a look at all the different contributions, and this does not include this particular one does not include things like mortgage forbearance or student loan deferment. So there's more to this than this chart shows, but it's just an indication. And this is the kind of thing that makes you look at it and say, again, people are sitting on a lot of cash, and supply chains are strained. Put the two together, and you got yourself a pretty nasty inflation. Add to that the fact that the workforce, took a while to recover. So there's still shortage of workers, and so you combine shortage of workers with demand for services as well, and again, causes these prices to spike. Here is one chart. If you're going to look at any charts at all, this is the one that tells you something's different this time around.
Wow.
Okay.
Wow.
This chart shows cash held by Americans. This is from Bloomberg, and cash held by Americans, and it is adjusted for inflation. And
yes,
here it is, right?
So look, can I ask you a question? In any of the data that you've just presented, do we understand, can we pinpoint why it is that in, I guess, late 21, we began a vertical from the country holding or households holding approximately 1 trillion in cash to nearly 6 trillion in cash within, or by the time January 1st, 22 came around? Do we know? Does data help us with insights into that?
Yeah. So this started sort of 2020 era, right? And it's got a delay because of the way the Federal Reserve records this data.
Okay.
And so it started with, there are multiple things happening. Now, obviously, not all of it is government support, right? Some of it is people selling securities and putting money in cash. Some of it is just increased savings because you're sitting at home, you're scared, you're not going to spend a lot in the first sort of few months. So people saved up, right? They
Right.
didn't go out, they saved money. But the rest of it is government support. The point is, you're going in a matter of, a year and a half.
Yes.
You're sitting on a just massive amounts of excess savings, and you don't need a lot of that to be spent. So when the spending started, and a lot of it started late in 2021, early 2022, people went out and started spending, and that just drove up inflation. Again, you look at this unprecedented as far as post-war U.S. history, and that kind of tells you where we are as far as
Yes.
Inflation is concerned. That tells a story.
Okay. So I guess at this point, maybe we should turn our attention to where inflation's headed in 23. What do you think
Right.
about that?
Right.
What does the data tell us there?
So the data tells us that inflation is headed lower rapidly, and there are multiple data points to indicate that. The most critical one is rent. Right, rent inflation has been stubbornly high. Landlords all of a sudden decided, time to hike rents a year ago, and they just went at it across the board. And it's a little bit of a game theory, right? Where your landlord, you're doing fine, you're getting rents, everybody's paying, but
Yes.
you hear about other people raising rents, and housing's a bit tight, home prices are through the roof. So that people are not going to necessarily go and buy a house. So they say, you know what? My competitors are raising rents, I'm going to do that too. And that's a sort of self-fulfilling prophecy, feeds on itself. And so rents, just shut up over the past year. And so, rent is one of these things there's signs of it finally starting to slow or decline in some cases. And so leading indicators point to slower inflation in rent. And that's the driver. Everywhere else, inflation has been coming down already. Part of it because supply chains are not as strained as they were, and things are flowing. Containers are coming in. Demand for containers has declined. The backlogs have eased, and so you have this dynamic where, at least on the good side, inflation has come down. You look at the.
And Lev, if I could just jump in for a second, ask you a question. You said something about containers, right? And I've read recently where the port of New York, New Jersey, and I guess Savannah, some of the East Coast ports have become once again more important in the import-export picture of the United States, to the disadvantage of Los Angeles, Long Beach. Is that a trend? I don't know if you have an opinion. Have you seen any data on that?
Yeah, it's a bit of a trend, in part because companies decided they cannot rely entirely.
Yeah.
It's a risk management tool, really. I'm a company. I bring in products from China, and I got to have my product ready for Christmas. And I'm afraid that
Right.
workers will strike, or there's going to be you basically have a funnel, a bottleneck in the ports of LA, and so people just said, I got to diversify,
Yes.
and they're doing that in terms of ports, but they're also doing that in terms of supply chains, right? If I've got factories in China, I can no longer rely on that entirely. I'm going to diversify to, whether it's Malaysia, Vietnam, or Mexico. And so
So now you're speaking to the ripple effect that has, right?
Yes.
That if we're no longer confident about sourcing materials, goods out of China, we want to diversify. So that's reflected in the point of entry into the United States. But perhaps most importantly, it points to where the product is actually manufactured, produced.
Yes.
Less likely to be in China than it once was,
Yes.
or East Asia. Yeah.
It's where's it assembled? I mean, you look at Europe, for example, and one country that I track closely is Turkey.
Okay.
Right? Turkey, has gone through hyperinflation.
Yes.
The worst inflation in a long time. The currency got devalued, and yet the economy has been really strong. And I remember thinking, what's driving it? What's driving that is European companies wanted to diversify away from China. And, just like the US is kind of using Mexico for, to reduce that risk, European companies were using Turkey. And so,
Interesting.
industrial production in Turkey has been very strong.
Interesting.
So this is just an example of, some of the beneficiaries of this whole, supply chain crisis. But it will take years, right? This is, to change, to adjust your supply chains, depending on what you do, but it could take years for people. And so this is a multi-year process. And so in the years to come, we're going to see shifts and changes in the way people source their manufactured product.
Okay. And so any more thoughts on where inflation is headed?
Yeah, so I just wanted to show this one chart. And this is what the Fed is really scared of. So,
yes. Yes. Wow. That's scary, Lev.
Exactly. So inflation is coming down. It's crashing.
Right, just make sure. Let's define the lines here, because I'm not sure everyone can read it.
So basically, the red line is the current inflation trend, and you can see it peaking and coming down.
Yes.
Right. The gray line is the inflation trend is in the 1970s, right? So starting in the early 70s, you had the first spike, and guess what? In the late 70s, you started with the second spike, right? And then you had the Fed really cracked down on and tightened policy, and inflation came down in the early 80s.
I can't read the bottom, but let me just ask you this. I know that in 1974, gold began its process of going, right. So gold went from 35 up to about 800 by 1980. So does that follow the red line?
It kind of follows the gray line. Probably didn't dip as much, but gold took off and had its big rally. But so if you look at the on the bottom here is this is 1983, and so you started 73 and 83. So this is about a decade, from the beginning of the first peak to the end of the second spike. Now
this is an eerie chart, I have to say.
I think when people look at this, they say, wait a minute, the fact that inflation is coming down doesn't mean that we won't get a resurgence. And inflation is one of these things that, from the data I've been seeing, it's kind of contagious, right? Meaning that once it starts, once you let the cat out of the bag, it starts. The ideas and people says, oh my God, I can raise prices and people are not going to complain. that sort of thinking. And so you could have a resurgence of inflation. And that's why, it's entirely possible the Fed will remain, even after they're done hiking rates, it will remain on hold for a while. Keep rates elevated for some time. Simply because they don't, this will kill their credibility. This will really damage.
And I think it's fair to say that regardless of your, let's say, intellectual view of economics, whether you're on the right or on the left, with the exception of modern monetary theory, I believe. Just about all economists would say that when you debauch the currency, that's one of the worst outcomes you could possibly have.
Yeah.
It's so destructive.
Yeah.
So, yeah.
Yeah. Once people sort of believe that there's inflationary pressures out there, behavior changes, and you have they demand higher wages.
Yes.
You have companies who basically say, well, it was interesting to see, and I have a bunch of data on this, but it's interesting to see companies that didn't have to raise prices, last year, but they did. Why? Because they could.
They could, yeah.
Right. And so, and the easy excuse is, look, we got supply chain issues, or we got to pay our employees more. And you look at the numbers, and the supply chain issues and labor costs, yeah, they increased, but not even close to the prices. And that's why you had this massive spike in margins.
So this was a good time to be a capitalist.
Oh my God. I mean, that's why the market did what it did. I mean, all of a sudden you had, especially in, some of the, like you look at tech companies, the margins just incredible. They just exploded. But, all corporate S&P 500 margins were just exploded last year. And that basically tells you, look, this is not about cost. This is about their ability, to increase prices, so pricing power.
Lev, let's turn our focus now to the labor market. What does the data say about labor?
So the labor market, and I'll have at the very end, I'll have one other chart to show you on the labor market, but the labor market has been exceptionally strong. And part of it is you got companies with great margins. They're growing, demand is strong. They're going to hire, and they're going to keep hiring. At the same time, you had all these factors that came in to hold back employment growth. You had a massive spike in retirements. A lot of people said, you know what? Not doing this, not worth it, right? Not worth it going in and worrying about, catching COVID. I'm done. And so people who could retire, a lot of them retired.
Yes.
And some said, look, I'm just going to take a couple of years off and see how it goes.
It's referred to as the Great Resignation.
The great retirement, right? The Great Resignation. So retirements was one. The other one that people don't like to talk about is immigration got shut off, right? And again, people forget that the U.S., if you look at natural labor force growth, outside of immigration, it's declining. Your population growth is basically almost
flat to
zero.
down, right? If it's that.
Yeah.
You don't include immigration, it's flat to down.
It's flat to down. And so, your economy is growing, and it was growing pretty quickly. You can't have the economy growing without the labor market growing.
Right.
And yet the labor market stalled out. So now you have the same kind of dynamic as you had with supply chains. You had this demand on the rise and supply is missing. It's just not there. But then you also had other issues. One of the big ones is childcare, right? If you look at childcare employment, it just never recovered. People said, I'm not working with bratty kids. I'm done with this, right? And so now all of a sudden you have a mom who usually would use childcare services to get to work. Can't do it. Can't find affordable childcare. Can't do it. And so she's like, you know what? I'm staying at home. I have to be at home.
So when we talk about labor, does Goldman Sachs have it right? Do they have some insight into the future? I see where they laid off several thousand workers. That was publicized.
Yeah.
What does that tell us about the future, if anything?
Yeah, the layoffs. There's been a lot of high-profile layoffs, and what's interesting is they're not showing up in the labor force. And the reason they're not showing up in the labor force is that a lot of those people who got laid off, and again, the media won't tell you this, a
Yes.
lot of those people got laid off, found jobs within days, really that quickly, right? The ones that didn't retire. Others said, look, I got enough money, or my spouse works, don't need
Yes.
this. I'm staying at home. And so your unemployment rate remains really low.
What about U6 though? How does that play in here?
U6 hit the lowest level in decades.
And can we just define U6 for our audience here? Exactly.
Yeah, so I call it underemployment. So that includes people who are marginally attached, or
So it's the individual that was making, let's say, 100,000 that all of a sudden gets rehired, but he gets rehired for 45,000.
Yeah.
He's underemployed.
Or folks who are basically, went from a full-time job to twice a week, something like that.
Sort of like the gig economy.
Yeah, but that underemployment, the U6, is the lowest in decades. I mean, I think it's the lowest on record, as far as the records we have.
So that should be a good sign, right? That reflects that the data we have about unemployment is more valuable, more reflective of the true state of employment.
Yeah, and I dig pretty deeply into the employment figures. There are some signs of strain here and there, but a great chart is, unfortunately I don't have it in front of me, but if you go to the Atlanta Fed, they publish what's called a spider chart, the labor market spider chart, and that basically gives you a snapshot, a picture of the employment situation in the U.S. And that's been tremendously strong and remains there, right? So clearly that's not going to stay there if layoffs continue. There's concerns and so on.
So what does that tell us about the likelihood of a recession in 23?
Right. And that's where it gets interesting. Let's do another chart.
Go ahead.
Since you asked, Bob. So here is a chart that shows, it's from the Philly Fed, that shows the probability of a decline in the economy, in the GDP.
Okay.
And so.
And I'm sorry, Lev. People may not be able to see the whole thing. I'm not sure. Oh, yes, we can. Okay, my apologies.
Yeah. So if you can see this, this is Q4. This is Q4. And so professional forecasters have never been this right. Professional forecasters have never believed that the recession is going to take place to such certainty. This is the most anticipated recession, if it does happen, in recent history, right? Of course, when somebody tells me it's the most anticipated something or another,
that's a contrarian trade. If I
to me it's like, let's step back and say, the crowd is clearly convinced there's a recession coming, right?
Yes.
And there's no question that the economy is slowing. There's no question that unemployment will probably start moving higher in the months ahead. But this tells me, this is like some of the other forecasts we've had, such as transient inflation, right? Everybody kept talking about transient inflation and so on. When the crowd piles in, I start to question it, right? So the question is, are they right? Right. And there are a few people, and you mentioned Goldman, who basically say, not so fast. Right. And here's the reason why other people are not necessarily convinced that a recession is coming. And these two charts kind of show something similar. The first one, I don't know if you can see this, is basically, back to deposits held by households.
Yes.
And this is going through Q3 of last year, just released actually recently. And it shows that, deposits, if you compare it to pre-COVID levels, deposits, they're down slightly. People spend some of their deposits, not a lot. There's a lot of cash still out there, right?
Yes.
There's still a lot of cash out there. At the same time, you look at on the right, this is from Bank of America.
Well, so it's a lot of cash, but also we have to factor in, these are nominal dollars, right? So
these are nominal dollars. You're right.
Factor in inflation here, right?
Correct.
So
they won't buy as much as they used to buy, for sure, right?
But still a lot of cash.
Still a lot of cash, and they're sitting on it, which means that, if households feel even a little bit better than they do now, you'll start seeing a little more spending.
Okay.
And guess what? 70% of the US GDP is consumer spending, right?
Yes.
So this is about the GDP, and it's about, hey, this is going to create a tailwind for consumption and for GDP growth. And so
do we know what kind of consumption? Does the data tell us anything about that?
A little bit. And that's why I wanted to point to this one, because people will say, okay, fine, everybody's got cash, but nobody's going to do discretionary spending. They're going to do, necessities. They're going to just buy they're going to go to
but washing machines, cars, stuff like that, or
more like, I'm going to buy rice or bread, groceries, right?
Got it.
That's what people are saying, but that's not the case, actually. If you look at, and this is through December, if you look at Bank of America card spending data, right? So Bank of America has a massive credit and debit card network. And what they're seeing is discretionary spending. This is discretionary, right? Not budging, at least as far as December, not budging. All right. So consumers sitting on cash and continue to do discretionary spending. Again, most likely this will slow, but is it enough to cause a recession? Maybe, maybe not. But so far, there's no evidence that consumers really are pulling back.
So far, it sounds like inflation, according to the data, right?
Yep.
Looks like it's under control. It also looks like the labor market will remain solid, strong.
Yeah.
And what we're saying is there's a completely different, notwithstanding the survey of economists, et cetera, it looks like there's a good argument to be made for the contrary position that the economy may not enter into recession.
Right. Everybody agrees that it will slow. That we'll have slower growth this year than we had in the past. But how bad will it get? It's not clear.
It doesn't look like we're headed for any catastrophe.
No.
Okay.
There is one risk that I look at that could precipitate a recession, and that is the debt ceiling fiasco.
Oh, yes.
Right. For those of us who remember 2011, when we came close to the precipice, where, the Treasury ran out of emergency funds, and all of a sudden, there was a possibility that we'll see what's called a technical default on treasuries, where all of a sudden, treasury coupons are not going out.
Yes,
that will trigger a recession for sure, because it will create, it will tighten financial conditions far more than anything else.
And that would be unthinkable, because the United States has made good on all of its debts over time, whether it's the Civil War, the First World War, Depression, World War II, you name it. The United States has always met its obligations.
Yeah. And people say, well, what's the big deal? We just delay the coupon until, but our government, will delay means you're not going to see your coupon for a while, or principal payments for a while. What people forget is the whole financial system is integrated with treasury coupon payments. And so when the coupon doesn't come out, it's not just the money that's not going through, the system just craters because
it grinds to a halt.
You have it's almost like the year 2000, when everybody was afraid what will happen to the systems. It's a similar thing, right? Nobody knows what will happen to the financial system when coupons don't go out on time, so that's a serious risk.
Well, it's the sort of the inverse of a run on the bank, right?
Correct.
It would be catastrophic.
Yeah, and so that one thing could trigger a recession. Obviously there are geopolitical risks.
Sure.
From Russia doing something crazy to China and Taiwan.
Yes.
Those
Lev, we're running out of time here. I just want to. There's so many other topics we want to cover here. Let's talk about housing for a second. What is the data telling us there?
Housing is cratering, and that's because it's really sensitive to rates, and mortgage rates, shot up to 7%, and houses already expensive, so affordability collapsed. People can't afford houses. However, unlike other countries, the United States has this 30-year mortgage, right?
Yep.
And so if you're in a 30-year mortgage, you're not in a hurry to sell because your payments are static no matter what, right?
Right.
And so sellers are saying, you don't want to buy at my price? No problem. I'll take my house off the market. And so supplies remain tight. And so there's debate whether how deep will the price decline be.
Yeah.
But we're not going to see anything close to what we saw in, say, 2007.
But isn't it true, Lev, that housing and construction, you were talking before about how reliant economic success in this country is on the consumer, right? So construction and housing play a big role in all this, right? So if that, to what extent will that slow down, right?
Yeah.
And will that impact the overall economy?
Yeah, I was shocked to see job openings in construction rising, construction jobs remaining high. Didn't make sense. And part of the reason is that
I'm sure they're hiring construction companies. Okay, got it.
Yeah. And part of the reason is that there's a huge backlog in construction. So there's a lot of projects that are already paid for, that got started, but because of the supply chain issues, they got delayed.
I see where I live. Yes.
They're coming through the cycle and they're still hiring. At some point, it's going to work itself out. And so you're going to see a drop in construction hiring and related industries. Mortgage industry is already struggling, right? They've laid off people. So you'll see an effect of it. That's the first.
So what you said a moment ago, which I think is an excellent point, how tied the housing market is to interest rates, right?
Yep.
So to take that one step further, what does the data tell us about the actions the Fed might take in 23 in terms of cutting rates? Did you say you thought rates would be cut in 23?
Well,
what does data tell us?
The data, the market is telling us there's going to be a 50 basis point rate cut in the second half of this year. That's what the market expects. That's not what the Fed is saying. The Fed is saying we're not touching rates because we got that double spike inflation risk, right? So the Fed will be watching a couple of things very closely. The most important one is the imbalance in the labor market. And this is just a really quick.
So would you say this is one of the key indicators to be looking at in 23?
So here's the key indicator to watch for. This is the ratio of job openings to unemployment. So right now there's about over 1.7 job openings per every unemployed American. Okay.
I'm sorry. Okay. So there's the excess supply.
Excess supply of job openings
Got it.
right. And so it's an imbalance in the labor market, which is driving wages higher. This is a key indicator to watch this year, because the Fed would like to see this come down to at least roughly where it was before COVID, right?
Right.
And this is something that Powell keeps pointing to, is that there is an imbalance in the labor market. Too many job openings, not enough people willing to work,
Right.
and that's going to drive the Fed's decision. As long as this stays where it is or near this, the Fed is on. It may raise rates or stay on hold. It's not cutting rates. The market expects a recession, and therefore it says, well, we're going to have a recession, unemployment is going to jump, and therefore the Fed will be forced to cut. And there's the imbalance. That's what everybody's watching.
Okay. Any other indicators in 23 that we should be keeping our eyes on?
So the other one that I'm tracking closely is the yield curve. So this is the
Yes.
this is the spread between the 10-year and the 3-month treasury yields, right? It's the most inverted in decades. And that tends to be a pretty good predictor of recessions.
50-50 or better?
Well, so this says 100%, right? But the question is, usually recessions don't start until the yield curve starts steepening. And so the key to watch is when it steepens, right? That's when you're closest to a downturn, a severe economic downturn, and that's the indicator to watch.
Yes, and it would appear it's headed in that direction right now. We've experienced that drop, right?
Yes.
So it's going to be interesting to see, and I'm going to ask you in our remaining minutes, given all the data that you're exposed to, and I think what we're seeing here is that the data says it looks like we're headed for choppy, if not stormy waters, okay, in the economy. Whereas earlier we said the labor market and inflation looked like they were headed in the right direction. And it looks like there's a good argument to be made that the recession, if there is one, will not be as deep as, let's say, many of these so-called experts think it will be. Is that accurate? So
correct.
It sounds like we've got conflicting signals.
There are plenty of conflicting signals. If you look at the dispersion of predictions for the recession, it's enormous. Some people, Deutsche Bank says it's going to be much deeper than everybody predicts.
Right.
Goldman says no recession.
Okay.
Right. Somewhere in the middle is the answer.
What does the data tell you? You have an opinion
right
on that?
Right now, the
Review,
data says no recession. That's what the data tells me right now.
Okay.
But things change, and that's
And what you're saying is we should be looking at unemployment and looking at the yield curve.
Yeah.
Right.
Job openings and the yield curve in particular.
Okay. So what you're saying is the data is telling you that these are probably two of the more important metrics to be watched.
And in particular, the job openings one is what the Fed is tracking, and so that if this corrects and goes back to below pre-COVID levels, the Fed might actually cut rates, but until then, it won't. Right. So that's the key.
So Lev, I have to say, unfortunately, we have run out of time.
Yeah.
We have to have you back again. I think this was terrific. I do want to thank you for a very interesting and thought-provoking perspective on data and why it's so important in understanding the shape of things to come. And as I said, we look forward to seeing you again soon. I also want to thank our audience for tuning in, and also remind everyone there to check our website, because we've got some very interesting events coming up.